So today we'll be looking at IAS 38 on intangible assets. So far, this will be the third standard we are going to be looking at. We started with IAS 1 that deals with presentation of financial statements. That was where we laid the foundation for us. Then we looked at IAS 16 on property, plant, and equipment, which we just stopped today. Now, the next one we are going is intangible assets. You see, both intangible assets covered by IAS 38 and the one of IAS 16 on PPE, both of them are non-current assets. Now, for intangible assets, the first thing we must immediately understand very well is what is an intangible asset. And the best place for us to understand it is by looking at the definition given to us in IAS 38. So let's look at the definition in IAS 38. So IAS 38 said that, he said, an intangible asset is an identifiable non-monetary asset without physical substance. See, this definition, I don't know about you, but for me, it doesn't help. It's not the best of definition we can have for an intangible asset. It's an identifiable non-monetary asset without physical substance. Why all this grammar? You see, before we even look at this definition first, the only thing I think we can easily get here is that it is without physical substance. That's the only thing that I think we can easily relate with. And when we say without physical substance, it means that we cannot touch it or see it or romance it or whatever the case may be. But that's what it means. That means it's just like the opposite of PPE from the physical perspective. It's just the opposite. And that's the only difference between intangible assets and PPE. Intangible assets majorly is without physical substance. You see, reading this standard, right, is not, I would say maybe it's somehow in terms of the examples they are using, because this standard dates back to 1998. I'm sure some of you here were not born then. Long time ago, 1998. And in 1998, then I think I'm not sure we had an iPhone then. What we had then was this they call it AirPod or something like that we used to listen to music. And the capacity then, the maximum was like, it wasn't even up to 25 MB. That was the maximum they could do. Now, these phones we are doing, some of them have almost 1 terabyte. So there's an extreme advancement in technology between when this standard was developed and now. But we are still using this standard. See, why am I saying all of this? The reason I'm saying this is this. When we talk about intangible assets, they are majorly technologically based assets. Majorly. So, majorly, the one you can relate with is softwares. Intangible assets are majorly softwares. Majorly. Though there are other ones like that. So, if you have an accounting software, okay, that is an intangible asset. If you have like an app, that is an intangible asset. Most of you that have Bitcoin, that is an intangible asset. If you have a website, that is an intangible asset. So think of it, majorly softwares. and there is a lot of advancement in that area. So this standard needs to advance in terms of this definition, in terms of some examples they are using. So I'll just try as much as possible to narrow the scope and make reference to it in terms of what is happening today. Okay, so let's go back to this definition. We already know generally what intangible asset is. So we have already cleared these two. But since this is still the definition we have, we need to able to we have to understand what they mean by identifiable, and we have to understand what they mean by non-monetary asset. So let's start with identifiable. So they say that an intangible asset is an identifiable. So let's stop there. You see, when they say identifiable, IAS 38 says that what they mean by an intangible asset to be identifiable, they said it means that it must be separable. They said it means it must be what? Separable, which simply means that you should be able to sell that intangible asset, or you should be able to transfer it to another party, or you should be able to lease it to another party without necessarily affecting the entire entity. So it should be separable. You should be able to sell it or transfer it or lease it without necessarily selling or transferring the entire entity. So separable. Be able to sell, lease, or transfer it without necessarily affecting. So that's what they mean by it should be separable. They now said, or not just separable, it could be that it arises from legal or contractual rights. It could be that it arises from what? Legal or contractual rights. And a major example of an asset that arises from legal or contractual rights is, you know what a franchise is? Most of these KFCs you see around Nigeria now, most of them are operating a franchise. If you see an authorized Apple dealer, it's mostly a franchise they are operating. So when you want to use the brand name of another company, okay, use their name to further your own business, you must have had a what? A franchise. And it doesn't come free. There's a university that I'm aware of. So it's in the US. So a guy wants to open a university. In fact, he has opened it. He's running already. So he wants to use their name. The franchise was almost $50 million. So it's not trivial. It's an asset. So this franchise, well, it's not separable. Because when you get a franchise, you cannot go and sell the franchise to another person. It's not possible. It will be in the contract that it is just you and you alone. It's not separable, but it is arising from what? Legal or contractual rights. Majorly when you have a franchise. And for being separable, the major intangible asset, example of these ones are maybe a license. If you get a license to operate a business or from government, it's an intangible asset because you will have paid a lot of money for it. When MTN were going to get their 5G license, they paid close to, I think, around $300 million to NCC for them to, so they had to bid for it. So they will give you, okay, you can install 5G into the Nigerian economy. So, and most banks, before you can operate a bank, you can't just go and open a bank. You have to get a license. So this license itself is an intangible asset, and you can transfer. People sell their license. They are actually transferable. Another one that is transferable is a brand, right? If you have built a brand, a name, you can transfer it to another person. Though the person you are transferring it to, the person has a franchise, right? But he cannot transfer it. But it's arising from legal or contractual rights. Okay? And there are a lot of other ones that we are still going to look at. But when we say identifiable, it's either it is separable or it is arising from legal or contractual right. Now, that aside, we have understood what they mean by identifiable. Why I don't totally like this definition is that it's not only intangible asset that is transferable or that is identifiable. Even PPE is identifiable. You can sell it. You can sell your, so it's separable. There are some that are arising from legal law. So it's not really particular to this, but that's how they chose to define it in 1998. But so it's okay. Now, the next one is non-monetary assets. So they say that an intangible asset must be a non-monetary asset. So what do we mean by non-monetary asset? So for us to understand what non-monetary asset is, we will need to understand what a monetary asset is. So when we understand that, it's just the opposite of monetary asset. So you see, a monetary asset is similar to what we call a financial asset that we're going to learn very soon, maybe in week 10 or thereabout. And when we have a monetary asset, they are assets where you receive a fixed sum. They are assets that you receive a what? Fixed sum. You know how much you are going to receive. It's just like the money you have in your bank is a monetary asset because you know how much you will receive. It's just like your trade receivables is a monetary asset because you know how much you are going to receive. You know how much the guy is owing you. Investment in debt instruments, what I mean is that you lend somebody money, you lend someone money, is a monetary asset because you know how much you're going to get back. Or you invest in shares, okay, is a monetary asset because you know how much you have invested and probably how much you are going to what? To get back. All of those are monetary assets where you are going to receive back a what? A fixed sum, fixed quote and unquote. But a non-monetary asset is where the future economic benefit varies. Okay? What you get back, the future economic benefit varies. And when you have an item that the future economic benefit you get from it varies, then that is a non-monetary asset. And that item might probably be an intangible asset. Again, being a non-monetary asset is not peculiar to intangible. PPE is also non-monetary. So it's okay. At least for now, we can make do with this definition. But neither have I've not seen any exam question that will really require you to start defining this. But the understanding of, I mean, now you know what a non-monetary asset is, and you know what being identifiable means. That has helped us, but it's not really peculiar to an intangible asset. So an intangible asset is an identifiable non-monetary asset without physical substance. So we can define PPE as an identifiable non-monetary asset with physical substance. I mean, they could have defined it that way too. It will fly. Okay? But they didn't define that way. They defined it in another way. So intangible asset is an identifiable non-monetary asset without physical substance. And what you need to know, you need to understand what non-monetary is. Even if you are not going to use it here, you use it in some other places and know what identifiable means. Okay, so that's the definition. Now, having known the definition of intangible assets, then the next thing is the recognition of an intangible asset. Who can remind me here the recognition criteria for PPE?
It's a kind of I'm confused somehow
Okay.
because you say in transferable that we can sell our license. If we sell our license, are we not going to, are you telling me that we will not know the value of money that we collect from the person concerning this non-monetary asset that you're talking about that is varies? It varies. I don't understand. Is it that the money will go up and down, or I don't understand?
Okay, so the money you are expected to get from an intangible asset is not from selling the intangible asset, it's from using it. So it's not the selling, don't relate it to that. Just that we are saying that it should be able to sell that intangible asset if you want to. Okay, but the non-monetary means that the benefit you get from using it will vary. You are not sure. It depends on the amount at which you sell. If it's an app, depends on how much you charge, whatever it is that you're getting. It's unlike trade receivables that you gave somebody, you sold goods, you know how much you collect back. These ones are different. Okay?
Sorry. Um, from the questions you just asked, that you said we don't recognize the money that we derive when we sell the license, rather it's the benefit that in the use of the asset. So if we want to recognize it in our book, is it recognized as that's the benefit, not the, is that what we recognize it in our books?
Well, if I want to answer your question, we will get there, really. So the questions you're asking is not really, it's not so, I don't know how to put it. You don't need it, right? So when you're talking about intangible assets, what you recognize is where we are going. The benefit is just revenue, income, right? Income. When you use an asset, you generate income. So that one is something else entirely. What we are talking about is the asset itself, right? So this one is just related, this non-monetary asset is relating to, okay, the money you make from it, it's you are not sure how much you're going to make. You can make plenty money, you can make little money, okay? That's just by definition, right? But now we are going to, okay, how do you recognize it? How do you measure it? And stuff like that. Okay, so let's start with the recognition first, right? So I was saying that who would remind me the recognition criteria for an item of PPE? When you class for PPE, you were not. Wow. When you class for PPE, when you class for PPE, yes. Okay. The way you're doing your face, you don't want me to call you. Let me call this guy. Yeah, yeah, tell us. Yeah, tell us the recognition criteria for PPE.
Okay, for an item to be recognized as a PPE, IS 16 states that it has to be probable that there will be future economic benefit that is associated to that item that will flow to the entity. Also, that it must have a cost that can be measured with regards to that item reliably.
That's correct. Please clap for him. That's very good. Let me shock you. See what you just said is the same thing here. The same thing. So the recognition criteria for PP is exactly the same thing as the recognition criteria for an intangible asset. It must be probable that future economic benefits associated with the item will flow to the entity, and it must have a cost that can be measured reliably. The same thing. Okay, so you can just put in your notes that the same as PPE. So we won't have to go through that again. We have spent a lot of time in that. Now, after recognition, the next one is measurement. And in measurement, the first thing is initial measurements. Okay? So how do we measure an item of PPE initially? How do you measure it initially? Who can tell me? Mr. Omar? How do you measure an item of PPE initially?
We measured an item of PPE initially at cost.
At cost.
Yes.
Can you please clap for him? That's correct. And we have explained that extensively in PP, that this cost comprises the purchase price, import duties, non-refundable purchase taxes, minus trade discounts or rebates. Abi? And we say it also includes directly attributable costs that includes initial delivery and handling, installation and assembly, employee benefits involved in the construction, professional fees, cost of testing, all of those things that we mentioned. You know what? Exactly the same thing here. Exactly the same thing here for intangible assets. However, listen to this peculiarity. Listen to this peculiarity. So, for initial measurements, the way you generate some intangible assets are peculiar, right? The one that is very straightforward is what we call purchased or acquired intangible assets. So everything we discuss in PPE, that initial measurement, all the cost, whatever, that subsequent measurement, cost model, evaluation model, everything, the way you, everything is the same. So we won't do that again. I'll just tell you to, so for purchase intangible assets, they are the ones like that you buy, like your license, okay, or even patent self, or your patent, or copyright, things like that, or even your franchise. So these ones, everything we learn in measurements in PPE applies to it. Everything. One area of difference is that for depreciation, for intangible assets, we don't call it depreciation. What do we call it? Amortization. That's just it. Aside that, it's the same. However, it's not all intangible asset that you buy. It's not all that you buy. Do you buy brand? You don't buy brand. Do you buy customer loyalty? It's an intangible asset too. You don't buy it. Do you buy goodwill? You don't buy it. You work for it. So see, those type of intangible assets, we call them internally generated intangible what? Assets. Like your brands, like if you have customer loyalty, you don't buy these ones. Like your goodwill, like some people have trade secrets that is only them that know it and is working for them. You don't buy it. Trade secrets and a lot more. There are a lot that you can think about, but you don't buy these ones. Now, if you don't buy it, then the challenge becomes, how do you measure it in your books? So under this one, in your notes, you should have noted that the same measurement basis as PPE. You should have noted that in your notes. Now, for this one, these intangible assets, note these examples in your notes. Now, let me dictate this to you. I want to dictate the next thing to you. Are you ready? Okay, Mr. Omar. Wow, that's fantastic. That's fantastic. So that's even another heading under this measurement for business combination, right? So there's usually a goodwill that arises on business combination. That one, since somebody has paid for it, then we can easily determine the amount. I think I will give you the notes. Let's write. I will note it. Thank you, Mr. Omar. Okay. These assets, I'm sure you have written internally generated intangible assets. These assets are not recognized. These assets are not recognized in the financial statements. These assets are not recognized in the financial statements because they don't have a cost. Because they don't have a cost that can be measured reliably. They don't have a cost that can be measured reliably. Full stop. On the contrary, on the contrary, these assets, these assets can only be recognized, these assets can only be recognized in the consolidated financial statements. These assets can only be recognized in the consolidated financial statements because a parent entity has paid for it. Because a parent entity has done what? Has paid for it. What I mean is this, like what Mr. Umar said, that if you buy an asset, or if you buy a company, and that company you paid 100 million for that company, usually before anybody will buy a company, what they are buying is the assets and liabilities of that company. And the first thing they do is due diligence. They will carry out a fair value measurement of those assets and liability. When they get that, they will give it to them. So ordinarily, if they did a fair value and the identifiable assets and liabilities of that subsidiary, of that acquirer or acquiree is 80 million, what the company should pay is how much? So if a company now choose to pay 100 million, that means, you see this 20 million extra they are paying, there is something they are paying for, that they know that what they are buying is beyond this asset. There's something. So IFRS 10 and IFRS 3 calls that what? That's what they call goodwill. Mr. Kazim will teach you this extensively. But that's the second paragraph I gave you. Now, on the contrary, this asset can be recognized in the consolidated account only. It's only in the group accounts, not in the individual account of the. It's only in the group, right? And it's because somebody has paid for it. This guy has paid for it. So also in group accounts, you will see that we can get a value for brand in group. They will tell you we can get a value for cost. We can get a value for almost all internally generated. And another one is even they call it maybe list of customer contracts or contracts. Maybe the person you are acquiring has a lot of contract. Maybe he has a government contract that they have already awarded to him. That's an asset. And when you buy the company, you buy all that. So they can attach value to stuffs like that. Okay, so, but now we are not looking at consolidated accounts. It's only in consolidated accounts this can be recognized. But in individual accounts, we cannot. How can we get the value of our brand individually? It's difficult. How can we get the value of our customer loyalty? How can we get the value of our goodwill, good name? How can we get the value of our trade secret? So all of these things cannot be measured in our books. Okay. Now, also, There is another type of intangible asset, but they separated that one. They separated that one, and they call it. It's still part of this another type. So for initial measurement, I have purchased intangible assets. That the same way you measure PPE. Yeah, there's this one that is not even recognized at all, and there's another one. They call it research. They call it research and development. Though it's part of internally generated intangible asset, just that it's huge. That was why we gave it a separate name. And you see, this research and development happens, for example, where you are developing, let's say, an app. You're a tech company, and you want to develop an app ground up on your own. So all the money you are spending, you will know it. You would know it. So they said all those money you are spending to develop that app, they call it research and development. Or maybe you want to develop a website or whatever, they call it research and development. Right? So you are writing. When an entity when an entity develops a dedicated product, when an entity develops a dedicated product in-house, when an entity develops a dedicated product in-house, like an app or a website, like an app or a website or any other software, comma, the cost incurred in these developments, on these developments, the cost incurred on these developments is known as research and development costs. Is known as research and development costs. Full stop. Paragraph. The entity, the entity must be able to separate the entity must be able to separate the research costs, the research costs from the development costs. The research costs from the development costs. Full stop. The research costs, the research costs, the research costs should be expensed to P&L. The research costs should be expensed to P&L. The research costs should be expensed to P&L. While the development costs, while the development costs should be capitalized, should be capitalized, should be capitalized as an intangible asset, should be capitalized as an intangible asset when they meet the following criteria. When they meet the following criteria. So for ease of remember, that's not dictating, I'm explaining now. For ease of remembering this criteria, because we have seen that in the exam, they don't really ask this one because it's the same thing as PPE. So when they want to ask, they rather ask PPA. And nobody will ask you all of these definition. So mostly they can ask you to list these internally generated that are not recognized in the books. That's why I told you to note it down. They can ask you in the exam. And the one they often ask is the criteria for recognition of development costs. So just for you to remember, I rearranged it and I called it, what's this? Yeah. So the P is that it means probable inflow of what? Of economic benefit. This is the first criteria. It must be probable that there will be inflow of economic benefits. This is the first one. The second one is that the entity must have intention to complete. They must have intention to complete development. This one, resources must or are available to complete resources are available to complete the development. And the next one is ability to use and sell the products. Ability to use and sell the products. The next one is must be technologically feasible to complete it must be technologically feasible to complete. And the next one is that the expenses incurred can be identified. The expenses incurred can be identified. So these are the recognition criteria for a development cost. So with this one now, you should be able to use it to remember it in the exam, because usually it's always like 5 marks, sometimes 6 marks. That's a lot. 6 marks. Just remember pirate, and that gives you 6 marks. Wow. Probable inflow of economic benefits, intention to complete the development, resources are available. These resources like money, both financial and human. Ability to use and sell. Okay? Technologically feasible and expenses incurred can be identified. So again, we are going to look at some in your question 1. They usually put some of these things as additional information. They will tell you that the company incurred research and development costs, and from these dates, the company now see that they can finish it and it will be viable, something like that. What they are telling is that from this date, we have now gotten to the development stage. So that means any cost we incur from that date, that is the one you capitalize. You see the one you are incurring before that date, you expense it, right? So again, this standard needs to be updated, because this is very controversial. It's extremely controversial, because there are some projects that you might not even know whether it will be viable until when it is close to when you are going to finish it. Does that mean a major portion of the cost will be expensed? That's what, but don't let us go there. Your exam is always very straightforward. Is that they ask you to list this one, or they will give you a clue that this is when the development cost has been, this is the development phase. Nobody will ask you to define research. Nobody will ask you to define. What we want you to know is that any research cost should be what? Expensed. And we also want you to know that from the dates of the development, they will tell you the dates. They will tell you. What we need you to be able to show, the knowledge you must express is that you know that from that date, any cost we incur should be what? Capitalized. That's all we need you to know. That's it. Okay. And really, that is it for IAS 38 on intangible assets. It's really not more than that. And I've really told you areas that you need to, to focus on. But let me ask you a question. Let me see if you can get it. You see, the peculiarity of most intangible assets is that most of them usually have unlimited useful life. Most of them, not all of them, most. So when it has unlimited useful life, how do we get the amortization? Unisa, how do you get the amortization? Who can tell me? How are you going? Do you know what I mean by amortization? The depreciation. So how do you calculate it? Okay, for depreciation now, how do you depreciate an asset with an unlimited useful life? How do you depreciate an asset with an unlimited useful life? I mean, this is not the time for punishment.